Welcome back to the deep dive. If you're like us, you want the shortcut to being well-informed, and today we are looking at a single, massive transaction. And this one, it acts like a mirror. It reflects the entire corporate strategy for accommodation in the Asia-Pacific market. We are diving into a really high-value real estate maneuver in Singapore, focusing on that elite extended stay sector. And this isn't just about the massive price tag, we'll get to that. It's about the strategic shift behind the investment. Our mission is to unpack this sale of a prominent serviced residence complex. We want to understand the playbook that these major financial players are using when they go after luxury corporate housing.
That's exactly right. This isn't just about, property deeds changing hands. It's really about revealing how large corporate entities are seeing the future of business travel accommodation. We need to analyze who is buying, who is selling, and most critically, why. Why is this shift happening in a sector that's for so long been the backbone for corporate teams on long assignments?
And the number that just sets the stage for everything, it's $289 million. That's the total sale price for the Oakwood Premier OUE Singapore, a key asset in one of the most competitive financial districts in the world.
And our sources here are great. They give us the specifics we need to really analyze the deal. They detail the structure of the sale, the asset itself, and the thinking that drove the buyers. We're talking about a joint venture between the Hong Kong-based financial firm AMTD Group and the hotel operator Dorset Hospitality International. And if you understand the structure, you really start to understand the future of the APAC hospitality market.
Okay, let's start with the nuts and bolts of the transaction, because the structure itself reveals a lot about how they're assessing value. The seller, in this case, is the massive property developer OUE Limited.
Right. And the asset being sold is the Oakwood Premier OUE Singapore. It's a very high-quality property. It functions as both a luxury serviced residence and a hotel business. And its location is, well, you could argue its greatest strength. It's on Shenton Way.
Right, in Singapore's central business district, the
Right.
CBD.
Exactly. And for corporate teams who rely on service departments for those long assignments, being close to the financial centers is everything.
And this property wasn't just sitting on its own right, it was part of a much bigger complex.
A huge one. It's a primary component of the OUE downtown mixed-use complex. To give you a sense of the scale here, we're talking about 268 rooms, and they range from studios all the way up to pretty substantial two-bedroom apartments. The whole thing spans level 732 of OUE Downtown 1.
So a big footprint.
A very big footprint. The gross floor area is over 25,000 square meters. It is built specifically for executives who need a high-end, comfortable base for extended stays. It's the exact kind of solution that business travelers look for when they use services like, say, Move and Stay to line up these long-term assignments.
Now let's talk about that $289 million. You mentioned the structure. It wasn't a simple single transfer, it was a deliberate two-part sale.
Yes, and that's critical to understanding the valuation.
Yeah.
It was explicitly broken down into two separate transactions. The vast majority of the price, $287.1 million, that was for the property sale itself.
Okay.
That was the transfer of the leasehold interest until July 2066, sold by an OUE subsidiary. So that's the value of the concrete, the land, the long-term rights to the building. And then you had the much smaller transaction, $1.9 million.
Just $1.9 million.
Right. And that covered the operational side, the service department business, and all its assets. That was sold by a different OUE entity.
Why do they do that? Why break it down like that? Why not just sell the whole thing as one operating unit?
Because it clearly separates the hard asset value from let's call it the soft asset value. The $287 million is about the prime real estate that will exist until 2066. The $1.9 million that covers the brand affiliation, the customer lists, the staffing contracts, everything that lets the business function from day one of the takeover.
Ah, I see.
It's a standard practice in high-stakes M&A. It allows the buyer to assign risk and value with a lot more precision.
And as we said, the buyers are two joint venture firms, AMTD Group, the finance giant, and Dorset Hospitality International, which is the hotel operating arm of Far East Consortium, or FEC. And they plan to rebrand it almost immediately.
Yep. To the Oakwood Premier AMTD Singapore. This tells you the new structure is a hybrid finance muscle meeting hospitality operations.
That brings us to the strategic core of this whole thing. Why did FEC and AMTD Group decide that this specific $289 million extended stay property was the right target for them right now?
Well, for FEC, it's a textbook strategic move. It strengthens their foothold in Singapore. They already operate the Dorset Singapore Hotel, so buying the Oakwood Premier lets them diversify their offerings. They're moving beyond just standard hotel stays into that luxury serviced residence
A
space.
different kind of customer.
Different customer and a different kind of revenue stream. And FEC was very public in stating that they saw the $289 million price tag as attractive. That assessment comes directly from the property's superb location, the quality of the building, and this is crucial, its potential for a market pivot.
Okay, let's drill down into that pivot, because this feels like the single most fascinating factor driving this whole deal. We're talking about a move from guaranteed long-term revenue to, well, more volatile but potentially explosive short-stay profitability.
This is the golden nugget in the source material. Service departments historically have mandatory minimum stays, a week, a month, sometimes more. It's built for corporate housing. However, the Oakwood Premier recently got a critical piece of paperwork, a hotel license.
A hotel license. That unlocks maximum flexibility. Why does that simple regulatory approval change the financial game so dramatically?
Because short-stay accommodations are generally considered far more profitable.
In terms of what, nightly rate?
In terms of revenue per available room, or rev pay hour as they call it in the industry, while long-term corporate rates offer stability and high occupancy, the daily rates for transient guests, the short-stay market, are much higher. They can spike dramatically during big conferences or peak travel seasons. They can capture that high-margin, flexible revenue that a dedicated extended stay solution, by its very nature, just can't. So getting that license means the new owners can shift their inventory almost instantly if they have low demand from corporate clients needing 3-month stays.
They can just open up those same rooms for 3-night stays at a much higher average daily rate.
Exactly. They're essentially buying an asset that can function as 2 different businesses under one roof. It's all about maximizing yield management.
That optionality has to be worth millions. But if they start shifting those units to short stay, what does that mean for their existing client base? You know, the professionals and corporate teams who need stable long-term housing.
That is the critical question. And the buyers, FEC, they anticipate that with some relatively minor asset enhancements, they can reconfigure the property to offer additional traditional hotel rooms alongside the service departments.
So they can play with the mix.
They can absolutely play with the mix. Maybe they reduce the number of 2-bedroom apartments in favor of more studio hotel rooms.
So they're literally increasing their earning potential per square foot by optimizing the unit mix toward the most profitable short-term setups.
That's it. It's a clear signal. The value is no longer purely in serving the long-term corporate client. It's in the ability to capture that quick, high-margin hotel revenue.
That gives us a really powerful insight into the buyer's motivation. But let's zoom out for a second and look at the corporate landscape, specifically the seller's side of things. In these huge transactions, there's often a fascinating backstory with internal governance, and this case involves OUE Hospitality Trust, or H Trust.
Absolutely. The sources reveal a crucial piece of internal maneuvering here. Before OUE finalized the deal with FEC and AMTD, they were legally obligated to offer the property to OUE Hospitality Trust first.
H Trust.
Right. H Trust, as a related entity, held the right of first refusal. This is a common mechanism designed to protect the interests of their own investors, to make sure the trust gets the first shot at buying high-quality assets.
So H Trust, which is a real estate investment trust, or REIT, had the first chance to buy this prime CBD asset that we just established, has massive flexibility. What did they do?
They declined.
They turned it down.
They turned it down. And their justification provides a masterclass in REIT investment strategy. They publicly stated that the purchase was not accretive to the distribution per unit, or DPU, of OUE Commercial Real Estate Investment Trust.
Okay, let's translate that technical language for our listener. When they say not accretive to DPU, what does that actually mean in simple investment terms?
It means that, based on their financial models, the cost of buying the asset, the $289 million, and bringing it into the trust would not generate enough additional income to positively increase the quarterly payout to their existing unit holders. REITs are legally obligated to return most of their income to investors, so their number one metric for success is boosting that DPU.
That is a staggering point of contrast. A private joint venture finds the price attractive because they see the potential for conversion and flexibility.
Right.
But the public investment trust rejects it because the immediate returns don't satisfy their DPU requirements. What does that tell us about the perceived risk and reward balance between these two types of buyers?
It tells us that public REITs, like the now merged H Trust and C rate structure, operate on a different timeline and with a different mandate than private capital. The REIT needs immediate quantifiable cash flow. It needs that accretive growth.
Whereas FEC and AMPD can play the long game.
Exactly. As private entities, they can afford to take a longer-term view. They're betting $289 million on future revenue growth that's driven by that hotel license, even if the immediate DPU boost isn't there. They're prioritizing asset flexibility over immediate yield.
That difference in investment philosophy is probably the most profound takeaway from this whole transaction. Let's quickly wrap up the final conditions. Were the two sales, the property and the business, dependent on each other?
Yes, they were explicitly conditional on concurrent completion. They had to close at the same time. One couldn't happen without the other. And because it's a leasehold property in Singapore, the sale also required a unique regulatory layer, the approval of Singapore's president, who acts as the head lessor.
Which just underscores the national significance of transferring major land rights in the CBD.
For sure.
And from the seller OUE's perspective, how did offloading such a huge asset impact their immediate bottom line?
Well, OUE stated the transactions were not expected to materially impact the group's net tangible assets or earnings per share for that financial year. That kind of phrasing tells you this was an anticipated strategic move. It was a planned disposal to optimize their capital structure, not some kind of desperate sale.
So we've spent our time examining this $289 million sale of the Oakwood Premier OUE Singapore. And what it illuminates is so much more than just real estate prices. It shows you exactly how major corporations are valuing service residences in these high-demand APAC hubs.
The central theme is the premium being placed on asset flexibility. This deal validates the high value assigned to properties that can instantly pivot between, dedicated extended stay apartments for corporate teams and high-yielding short-stay hotel rooms. That hotel license was the key that unlocked the entire valuation.
It's compelling, but you have to think it's also a bit concerning for the long-term traveler. We're seeing owners prioritize the immediate higher returns offered by the transient hotel market over the stability of serving that long-term corporate clientele. The very people who rely on specialized services like those offered by Mustay for these complex, longer bookings.
Which brings us to our final thought for you to explore. This transaction confirms that prime real estate, traditionally dedicated to long-term corporate housing, is increasingly being viewed by investors as a conversion opportunity, a chance to cash in on transient hotel rates. So if this trend continues across Singapore, Hong Kong, and other major APAC cities, what does this ultimately mean for the availability, the stability, and the pricing of truly long-term, dedicated, extended stay solutions for the corporate traveler? If every service department can become a hotel room overnight, where does the long-term professional go?
That is the crucial question facing corporate travel planners and developers everywhere. Thanks for joining us for this analysis. We'll catch you next time.